Alfonso is the CFO at Bluefin Seafoods. Bluefin supplies consumer retail outlets with sustainably grown seafood products. Alfonso wants to determine the company's net profit margin and compare it with industry averages. Net profit margin is an important financial ratio because it includes all expenses and income in the calculation. When executives, investors, and creditors talk about the bottom line, they are talking about net profit and net profit margin. Net profit subtracts cost of goods sold, COGS, operating expenses, and all other expenses such as interest payments, taxes, and accounting expenses from net sales. At the end of the current fiscal year, Bluefin had gross profit of $1.5 million on sales of $5 million, a gross profit margin of 30%, operating expenses of $1 million, operating profit of $500,000, and a 10% operating margin. During the same year, Bluefin had depreciation charges of $120,000, interest expenses of $40,000, and $102,000 in taxes. This leaves Bluefin with a net profit of $238,000. To calculate the net profit margin, Alfonso divides the net profit by net sales, giving 4.76%. This poses a dilemma for Alfonso. Bluefin's competition regularly reports net profit margins in the 7 to 9% range. Alfonso knows investors use net profit margin to compare companies. To remain competitive, Bluefin needs to improve this metric. Improvement will require the commitment of everyone from sales and manufacturing to operations, supply chain, finance, and accounting. This is the last year Bluefin will incur the $120,000 depreciation expense because the manufacturing plant it purchased 10 years ago is coming to the end of its depreciable life. However, due to excellent care and maintenance of the plant, Alfonso believes Bluefin could extend the life of the plant by an additional 3 years. Even though the manufacturing plant's life could be extended, some of the equipment in the plant is out of date. Bluefin's vice president of sales has told Alfonso that without new equipment, sales will grow by only 2% due to capacity and quality constraints. With the new equipment, she is confident that sales could increase by an additional 7% for a total of 9%. Alfonso decides to run a few scenarios. First, Alfonso forecasts a 2% increase in sales and no purchase of new equipment. In this scenario, Alfonso keeps COGS at 70% of sales and selling, general, and administrative expenses, SG&A, at 20% of sales, matching the current year. This yields a net profit of $329,000, or a net profit margin of 6.45%, an improvement over the current year, but not within industry averages. This scenario also puts the burden for change on the sales force. While it's important that Bluefin sees an increase in sales, Alfonso believes that every function in the organization needs to contribute to the turnaround to ensure success. Next, Alfonso includes the purchase of the new equipment, with a 9% increase in sales. The new equipment costs $300,000 and will be depreciated at $30,000 per year over 10 years. COGS and SG&A remain at 70% and 20% of sales respectively. In this scenario, net profit increases to $332,500, but the net profit margin falls to 6.1%. Alfonso runs one final scenario. In the third scenario, sales increase by 9%. The product and manufacturing teams are able to reduce COGS to 68% of sales and SG&A to 19% of sales. The finance team contributes by refinancing debt and reducing interest expense by 2.5% from $40,000 to $39,000. This scenario has the desired effect. The increase in sales with the reduction in COGS improves the gross profit margin to 32%. The reduction in SG&A increases the operating profit margin to 13%. By refinancing debt, net profits come in at $447,650 for a net profit margin of 8.21%, landing firmly in the center of the 7 to 9% range. After consulting with his executive team, Alfonso moves forward with purchasing the new equipment. By the end of the following year, each business unit had met or exceeded its targets, and the net profit margin had improved to 9%.